All right, let's talk about investing. It can feel like this straight shot to building wealth, right? But honestly, for most new folks, it's more like a minefield of really costly mistakes. So today, we're going to break down the 7 biggest traps that new investors fall into and, way more importantly, how you can sidestep them completely. Let's dive in. You know, investing has totally gone mainstream. A recent Gallup poll shows that 62% of US adults now own stocks. That's a record high, which is awesome. It means the market isn't just for Wall Street experts anymore. It's for, well, all of us. But here's the big question, right? While more people are in the game than ever before, are they actually prepared? Knowing how to click buy on a stock is one thing, but knowing what not to do, well, that's arguably even more important. So here's our game plan for today. We're going to look at the 3 big traps of mindset, then 4 traps of strategy, and finally, we'll map out your path to building real wealth. Okay, first up, the internal game. We're talking about the psychological hurdles that can completely sabotage your success before you even look at a single stock chart. The first and maybe the most common pitfall is just jumping in without any real direction. I mean, think about it. It's like starting a road trip with no destination in mind. Are you saving for a down payment in 3 years? Or are you saving for retirement in 30? The answer completely changes your strategy. You know that old saying, if you don't know where you are going, any road will take you there? That's exactly it. Without a clear goal, you're just making decisions based on feelings and noise, not a solid plan. And that's a recipe for disappointment. So the fix here is actually pretty simple, but it's so powerful. You gotta define your goals. What do you need money for in the next few years? And what about 20 or 30 years down the road? Just the simple act of writing these things down creates this financial compass that's gonna guide every single decision you make. Now for trap number 2, getting lured in by the deafening noise of market hype. We've all been there. You see a stock just shooting for the moon, everyone in social media is talking about it, and you feel this intense pressure, like you have to get in on the action. That feeling has a name, of course. FOMO, the fear of missing out. It is a powerful, powerful emotional urge. It's fueled by this bias where we think, well, if everyone else is doing it, it must be the right move. It just completely short-circuits our rational thinking. It causes people to pile into an asset at its absolute peak, right before the inevitable drop, which leads them to panic and sell at the bottom. It is the classic way to destroy wealth. The third mindset trap is this belief that you can somehow outsmart the entire market. I call this the fool's quest for perfection, but you probably know it as market timing, trying to perfectly predict the absolute lows to buy and the absolute highs to sell. And the cost of being wrong here is just staggering. Check this out. Research from JP Morgan shows that if you missed just the 10 best days in the market over the last 20 years, you would have cut your total returns in half. 50% gone, just from trying to be a genius.
So look, the really crucial point is this. The real winner isn't the person who tries to time the market. It's the person who maximizes their time in the market. One is a stressful, impossible guessing game. The other, it's a proven path to patient, consistent growth.
Okay, so now that our mindset's in the right place, let's move on to the practical side of things. Actually building a portfolio that can, withstand the test of time.
This one is a classic for a reason. Trap number 4 is putting all your faith and all your money into a single investment. It doesn't matter if it's one company's stock or one hot cryptocurrency. This lack of diversification is basically like walking a tightrope with no safety net below. The defense is simple. It's called diversification. It just means spreading your risk across different kinds of assets, like stocks and bonds, and across different industries and even different countries. The idea is that when one area is down, another can be up, which smooths out the ride and protects your money. Next up is a mistake that's silent but absolutely deadly: ignoring fees. Brokerage costs, transaction fees, fund management fees, they might all seem tiny, like fractions of a percent, but they are hidden wealth killers that compound against you over time. Just look at the damage fees can do. Let's say your portfolio earns 6% a year. A 2% annual fee doesn't just reduce your return to 4%, it literally cuts your entire growth engine by a third. And to put that into perspective, on a $10,000 investment over 30 years, that small fee could cost you over $75,000 in potential gains. The difference is just astronomical. Okay, The sixth trap is investing in something you fundamentally do not understand. You might have heard the company's name, or maybe a friend recommended it, but if you can't explain what the company does or how it actually makes money, you're not investing, you're gambling. Plain and simple. Seriously, consider this a fundamental rule. If you cannot explain how a company makes money, do not buy its stock. This simple rule forces you to do your own research and actually develop real conviction in what you own. And that conviction is the ultimate defense against buying into hype. And our final trap is just plain old impatience. This is the lottery ticket mindset, the expectation that you're going to get rich quick. Real investing is a long game. It's not a sprint. And chasing those fast gains almost always leads to taking on way, way too much risk. See, patience gets rewarded with one of the most powerful forces in all of finance, compounding. This is where your returns start generating their own returns, creating this amazing exponential growth curve. But it has one non-negotiable requirement: time. So let's bring it all together. Avoiding these 7 traps really just comes down to these 3 simple principles. First, have a plan that's based on your goals. Second, be disciplined enough to stick to that plan and ignore all the noise. And third, be patient enough to let your plan actually work. And that's our look at the key pitfalls for new investors. It really leaves us with one final, crucial question to think about. When you look at your own strategy, is it built for the long, steady marathon of creating wealth? Or is it built for a short, frantic, and, let's be honest, often failing sprint? The choice ultimately is yours.